How to make money and grow rich. This is the most commonly searched word on internet among today's generation. And even without the internet, this has been mankind's most asked question across classes, gender, and economic condition for ages now. At NE8x Insights, we understand the pulses of evolving world and rush towards financial freedom among the youths and beyond today. We bring to you concise and brief insights based on knowledge derived from 5 of the best-selling authority books in the domain of financial and self-help category. Get ready to explore the art of attaining financial freedom based on a fresh and practical approach towards money, savings, and wealth psychology. The third book that we will be covering here is among our most favorite. So let's get it started. Like this video, press the bell icon for notifications, and don't forget to subscribe. Recommendation number 1. The Psychology of Money. Written by Morgan Hussell, this 252-page book shares 19 short stories exploring the strange ways people think about money and teaches you how to make better sense of one's life's most important matters. The Psychology of Money offers timeless lessons on wealth, greed, and happiness. It offers insights on how money rotates in our economy and guide on taking rational financial decisions. We all are aware of the role finance plays in our everyday lives. But still people rarely touches upon this topic or hardly try to educate themselves financially and in their entire lifetime. Myths and stereotypes around money have evolved over years and people have their own opinion on the same. Sadly enough, most of the discussion around money is of inheritance and that rich people have inherited it from their families and the cycle keeps going on. Although with advent of time, people have started to believe that only true disruptors or exceptional investors are able to gather immense wealth. What we fail to realize is that all it takes for a start is to just change the mindset and incorporate a fresh perspective based on the fact that money is a universal circular asset in the world and that financial independence is attainable from a wide variety of activities and financial decisions that you undertake. To start with, you all have to be self-aware and acknowledge your financial situation first. Financial decisions taken in the past based on emotional bias have to be clearly identified and analyzed. You have to start with understanding the difference between your present life and comparatively analyze the life you desire. Over time, it will get easier to identify certain key areas and choose what to keep and what to get rid of. Emotional bias can play a significant role in controlling your financial decisions. The book thus encourages you with practical guidance on improving your financial status starting today. It lays stress on exploring a plethora of better choices especially when it comes to managing your money. Here are 3 key insights from this book. Insight 1. Your thinking can be blurred by envy, as strong emotions should have no place in the money market. Meaning, we should always consider certain factors, especially when it comes to money and investing, and accordingly learn how to control them in order to become wealthy and successful. Besides envy, other strong emotions like the fear of missing out also impact us at times. Evaluation based on your investment can help you analyze and choose to place certain trades, which you have to stick with them through ups and downs. In your journey towards attaining financial independence, the emotional factor is among the important aspects that you have to avoid at any cost. You have to remind yourself constantly that comparing yourself to more wealthy or successful people will yield no results, as ultimately your journey towards attaining the goal is going to be your own story, and it has to be unique anyways. Explain with the example of Rajat Gupta, the ex-CEO of McKinsey. Although belonging from a modest background, he made it to 100 million net worth, and still envious of Warren Buffett for being a billionaire. Even after reaching such a financial position, he committed insider trading, which is regarded as one of the most dangerous financial crimes for investors, as the latter of which later got charged with a prison sentence as punishment for the same. In short, his envy led him to commit such a crime regardless of his position. Lessons like this are valuable for folks looking to make better financial decisions. Being rational, ethical, and thinking twice on money-related matters by keeping the emotion factor out always helps. Insight 2. If you don't want to make the biggest financial mistake, then leave the greed at the earliest. Meaning, we never label ourselves as greedy. At least that's what we believe about ourselves. We instead always think highly of ourselves and blame our misfortune on unlucky odds. Let's take the example of Jesse Livermore, a trader who took a short position prior to the market crash that occurred in 1929, which meant that he took on the bet that the stock market will fall. This turned out to be his best decision, as he made $3 billion during this time. But things did not stop here. This huge amount would have been enough for setting up his life, but instead this winning trade made Livermore more invincible. But within some time, Livermore lost this huge amount by placing all the wrong trades, and eventually this sudden downfall demotivated him so much that he was forced to end his own life one night. This incident teaches us a lesson: to be humble and never be greedy about what we accomplish. When we already have what we wished for or completed significant goals in our life, we should learn to be fearful, maintain a status, and enjoy the present, instead of always seeking more and being greedy. Insight 3. Experiences from our early life with money can determine our financial decisions. Meaning, childhood upbringings differ from person to person. Things that look natural to you might be completely unfamiliar or unheard of for someone else. For example, if you are someone born in the 90s, your childhood would be way different from those of people in other century altogether. Added to that is the fact that there are people growing up in times of a financial crisis. And on the contrary, there are people who experience bull market trade even for a long decade. This two types would naturally have very different fundamental opinions about what a good investment strategy looks like or consists of, and whether a portfolio should be stock-based or based on bonds, or how much risk is worth taking for them at certain stage. A study conducted by Ulrich Marmontier and Stephen Nagel proves that most of the people invest according to how the economy looked like back when they were young adults. And this counts as a hidden biases towards the investment they make. As a result of which, someone who, let's say, has experienced high inflation may not see bonds as a practically a good investment. And while on the other side, someone who has been through rough times for the stock may quit as well thinks the opposite. It is hence very important to acknowledge and counter our hidden biases and the way we think, so that we can differentiate them properly and make better financial choices. While taking any financial decision, it should always be backed by sound analysis and based on reliable fact-checking. Rushed investment can impact years of savings, and while valuable ones can speed up your journey to financial freedom, sometimes it might also contradict your inner beliefs. As you work towards adapting the new trends, the money market thus has no place for subjective biases or impulsive decisions. NE8x recommends the psychology of money to folks in pursuit of financial coaching and management for unlocking wider investment and return in due course of time. The book is recommended for folks in early 20s as well as professionals who want to expand their learning horizons in the domain of finance. The book will surely help you manage finance better and clear out lot of financial myths and stereotypes. Before we dive down to recommendation number 2, let's share 5 significant fundamentals around money that we personally follow. These are commonly discussed money rules and principles that apply to all. But following common rules can fundamentally result in uncommon and exceptional returns, which most of us miss. Sharing some basic money fundas that you can follow in your investing journey. This includes the 60-30-10 investing rule. With this investing rule, you will use 60% of your pay to build your savings, invest, or pay off debts. Next, you can spend up to 30% on your needs, which can include your food, housing, utilities, healthcare, and transportation. Finally, the remaining 10% of your budget, you can keep it for discretionary spendings. The 20-10 rule. This rule is divided into two parts, that is 20. Never borrow more than 20% of your yearly net income, and 10. That is, monthly payments should be less than 10% of your monthly net income. Please note that the 20-10 rule does not apply to home mortgage. The 60-40 strategy. This strategy allocates 60% to stocks and 40% to bonds. Do note that bonds are a traditional portfolio that carries a moderate level of risk. The 60-40 strategy revolves around investment diversification. 8% sell rule. If you wish to make money in stock investing, you must first protect the money you have. Always sell a stock if it falls 7 to 8% below what you have paid for it. Live to invest another day by following this simple rule. The rule of 72. This rule provides an estimate on the number of years it will take the money to double in respect of the interest rate. To use this rule, divide 72 by the expected annual rate of return to get the number of years it will take for your money to double in value. Recommendation number 2. The Richest Man in Babylon. Written by eminent author George Samuel Calhoun. This 152-page book offers insights on how to become wealthy and how to attract good luck, and discusses the 5 laws of gold. From the importance of saving to the essentials on how to become wealthy. This collection of famous Babylon parables imparts financial wisdom. George S. Calhoun was a soldier, businessman, and a writer. Although this book was published in 1926, the timeless advice in this book is still relevant today. It is a widely accepted fact that Babylonians discover many of the basic principles behind wealth, starting with saving a small part of your income on monthly basis, investing wisely, lending money instead of borrowing it, and protecting your wealth. If you want to truly master the concept of money, The Richest Man in Babylon is a must-read for you. The book delivers financial tips by wrapping them into amazing stories. The chapter in book includes the man who desired gold, followed by Babylon's richest man. The book goes on to explain the 7 cues for lean purpose and meeting the goodness of good luck. Regarding gold, the book throws light on 5 laws of gold and the gold lenders of Babylon. It is followed by walls of Babylon, camel traders, clay tablets from Babylon. It then concludes with the luckiest man in Babylon and a historical sketch of Babylon. Here are 3 key insights from this book. Insight 1. learning how to get lucky by your hard work. Meaning, none has ever said that luck was something that can't be manufactured. There's something else as well that is called as chance. Along with probability, it is a random occurrence with a very little likelihood of happening, such as winning the lottery or being struck by lightning. But luck, however, is based on opportunity, and you can create more opportunities by working hard and improving your efforts. Explained with the example of Jerry Winthrop's story, who called on Elvis' manager every day for a year to pitch him a tour he wanted to take famous singer Elvis on. 364 times the man replied no, but eventually on 365th day he said yes. Jerry in this case did not get lucky. He worked hard to attain his goal. Every day he timelessly called and followed up without fail, until the time was right and the opportunity presented itself to him. That's how people working hard tend to get lucky. Insight 2. The art of living below your means. We always tend to wonder what makes rich people rich. While asking this, we are not referring to millionaire kids or oil sheikhs who have inherited wealth. We are talking about folks who, after working hard for a few decades, can walk out of the door of their jobs and never return again, because they can live off the wealth they have accumulated. We often wonder, do they save every penny, or did they work abnormal hours no one can keep up with? On introspection, we instead realize that the truth is somewhere in the middle. Wealthy people develop their riches mostly based on these two things. Number 1. Living slightly below their means. Number 2. Investing the money they save well. Living below your means is the first checkpoint. You have to cross at least half the money to invest. You know best where you have been spending money just for the sake of convenience, entertainment, gratification. That's really not necessary, and that's exactly the money you should be saving and investing instead. You should always try to spend less than what you earn. The Richest Man in Babylon suggests that you should save 10% of your income to invest. Hence, it is advisable to cut your expenses into that you are unnecessarily spending, and you can easily attain that 10% amount for investing. We also believe that you should save at least 10 to 20% of your income, and you can see the change in a year's time when you have already made significant savings along with small portfolio of stocks over the year-long period. Insight 3. Avoiding debt at all costs. Meaning, we live in a world where the average American is over $150,000 in debt, and thus avoiding debt at all costs further. is beyond the point of any logical argument. While taking the steps to build wealth, we start with quitting the irrational self-talk that makes us justify the purchase we can't afford. We have to be aware that money is a pretty rational thing, and we have to treat it that way. Let's say when you can't afford to buy a fancy new car or flashy TV, you can't afford it. But instead, you go out and get a loan to finance it. You will definitely delay your journey to wealth in multiple of months or even years. Because additionally now, you have to spend the money you save each month to pay off the debt instead of being able to invest it. Thus, instead of solving our problem with loans, we have to ask ourselves, how can I afford this? And accordingly figure out ways to make more money by increasing our income or try to save more, so that we can buy the things we want debt-free. Taking on debt has never been known to solve any problem. Instead, it creates more. So take rational purchase decision, avoid debt, and instead start saving more. NE8x recommends The Richest Man in Babylon to folks joining the corporate in early years who have started earning. The book is a detailed read for salaried as well as self-employed people for their spending habits and guiding them on purchases and expenditure. It is also recommended to people who have taken debt to finance luxury purchase or have similar interest in this domain. Before we reveal recommendation number 3, which is our favorite, we urge you to please like, comment and subscribe to our channel for discovering such insightful content on your feed. Please don't forget to comment your key takeaways and learning from this video. Recommendation number 3, Rich Dad, Poor Dad. Written by renowned entrepreneur Robert T. Kiyosaki. This 336-page book has made waves in the area of personal finance arena. Rich Dad, Poor Dad is Robert's story of growing up with two dads, his real father and the father of his best friend, his rich dad, and the ways in which both men shaped his thoughts about money and investing. The book explores the myth that you need to earn a high income to be rich, and explains the difference between working for money and having your money work for you. With over 40 million copies sold, Rich Dad and Poor Dad is one of the most influential books on personal finance. In the book, Robert tells the story of his biological father and the father of his childhood best friend, who taught him the financial education to become rich. The book points out how different both of them were when it came to dealing with finances. The book, Rich Dad, Poor Dad, covers chapter on teaching financial literacy, explaining why rich don't work for money. It is followed by insights on minding your own business and history of taxation. The book further explains on how the rich invest money and stresses on the fact don't work for money. The concluding chapters are on overcoming obstacles and to-dos to get started. Let's explore the lessons from the book in detail. 1. The rich don't work for money. Meaning, majority of the rich people do work very hard. Unlike what we might assume, rich people don't work for money. In fact, they make their money work for them. This is the fundamental behind the chapter's title and the underlying concept that Robert highlights in the book's opening chapter. People who aspire to become rich work and learn every day on how to put money to work for them. As Rich Dad says, the poor and middle class work for money. The rich have money work for them. Kiyosaki explains that having a regular job is a short-term solution to the long-term problem for creating true wealth or achieving financial freedom. It is the fear that keeps most of the people working at the same job year on year. The fear of not paying their bills, the fear of being fired, the fear of not having enough money, and the fear of starting over. That's the piece of study to learn a profession or trade, and then working for money. Most people become a slave to money and then get angry at their bosses. Sadly enough, that's the hard reality most people face. The rich, however, take risks by building assets instead. Chapter 2. Why teach financial literacy? Meaning, this chapter is an eye-opener regarding the concept and the difference between an asset and a liability. It is said that it's not about how much money you make, but how much money you can keep. An asset is something that has value, produces income, or appreciates, and has a market where the asset can easily be bought and sold. While on the other hand, liabilities make you lose money because of the costs associated with them. An unusual case study regarding the same is of our residence or house. Because by definition, a personal residence is not considered as an asset unless it appreciates enough to offset the cost of ownership. While on the other hand, rental property is an asset because it can generate enough passive income to exceed the expenses of operating and financing the real estate. So in the second chapter, Robert Kiyosaki asks reader to focus on the effort in buying income-producing assets and thereby keeping liabilities and expenses low. Chapter 3. Mind your own business. Meaning, Kiyosaki mentions that often people confuse their profession with their business, spending their entire life working in somebody else's business and helping make other people rich. So the key message here is to pay your debts at the earliest possible and to invest in income-producing assets. Following this, it is imperative to stay financially healthy by spending time and investing money in assets. This is what should concern you at this stage, instead of just your paychecks. Robert sums up the chapter saying, the primary reason the majority of the poor and middle class are fiscally conservative is that they have no financial foundation. They have to cling to their job and play it safe. They cannot afford to take the risk. Chapter 4. The history of taxes and the power of corporations. meaning this chapter covers four main components of what Kiyosaki calls financial IQ: accounting, investment strategy, market law, and law. Kiyosaki says that the rich understand the power of company structure and the tax code and use every legal means they can to minimize their tax burden. You can compare how business owners and investors with corporations such as C Corps, S Corps, or LLCs pay taxes to how most people pay tax. Thus, you can clearly understand that business owners with the corporate structure earn spend tax, whereas employees who work for corporations earn pay taxes and spend. You can notice that employees who work for somebody else spends their money post-tax, while business owner earn and spends before paying tax. In this chapter, Kiyosaki reminds us that understanding the legal and tax advantages significantly contribute to building long-term wealth. Chapter 5. The rich invent money. The chapter throws light on understanding financial opportunities. With this insightful quote, some people argue that there aren't real estate bargains where they are, but there are prime opportunities everywhere that are overlooked. Most people aren't trained enough financially to recognize the opportunities in front of them. By investing money, Kiyosaki means finding opportunities or deals that other people don't have the skills, knowledge, resources, or contacts for. The chapter clearly defines two types of investors. Kiyosaki says that professional investors train to identify opportunities that others haven't found yet, then to raise funds for investment, followed by working with other intelligent people, while most people on the other hand entrust the money to a developer or fund manager. Chapter 6. Work to learn. Don't work for money. Kiyosaki discusses the synergy of management skills needed for success in any business as cash flow management, system management, and people management. He writes, I recommend to young people to seek work for what they will learn more than what they will earn. Look down to roads at what skills they want to acquire before choosing a specific profession and before getting trapped in the rat race. Robert's poor dad was intelligent and well educated and worked for money because job security meant everything to him, while his rich dad became a millionaire by working to learn. If you follow Robert's life story, he joined the Marines after graduating from college and learned the essential business skills of lending and managing people there. After serving his country, Kiyosaki went on to join Xerox, overcoming his fear of rejection to become one of the top salesperson in the company, and then eventually left the corporate world to form his own business. Overcoming obstacles. This chapter talks about the type of obstacles
people face on the path of becoming financially independent. Kiyosaki Essential mentions 5 such obstacles that includes fear, cynicism, laziness, bad habits, and arrogance. Robert says that the primary difference between a rich person and a poor person is how they manage fear. By fear, he refers to fear of losing money and focuses on how to handle that fear. People who have studied and achieved financial literacy are still unable to develop assets that generate plentiful amount of cash flow due to these roadblocks and their failure to overcome them. Getting started. Kiyosaki says, people who choose to become one of the masses never take the time to develop their financial genius. It goes on to mention that there is a gold everywhere. Most people are not trained to see it. The world we live in has a great and big role to play towards how we think and how clear our vision is. If we are trained from a very young age to work hard for someone else, spend the money that we earn, and borrow more if we run short, the same keeps repeating in our mind over and over again across time frames in our life. The chapter then goes on to explain steps to getting started on a financial journey and exploring opportunities around. Concluding chapter, Suggested to-dos. Towards the final section of Poor Dad, Robert Kiyosaki sums up the learnings and key points in his book into a checklist that you can start following today. He says that to start with, first stop doing what you were doing by taking a break and then analyze properly on what is and isn't working. Then look for new ideas, scout for resources or unique niche. You can also approach mentors or resource persons for guidance in your journey. Save your time and experience more by learning. Then start with multiple offers. Eventually you will have your yes moment. Kiyosaki asked readers to spend 10 minutes each month for the next 1 year by walking, running and driving a certain areas and looking for changes. Always believe in the power of action and keep reading and learning from the history. You can shop for real estate when the market corrects. Also learn how, when and where to buy by investing and valuing your education. NE8x recommends Rich Dad Poor Dad to folks across ages for helping develop their general mindset about money in life and beyond. The book is a timeless guide for people across all age groups and economic conditions to help them understand the basic difference in assets and liabilities. Highly recommended for leaders, entrepreneurs and students who aspire to achieve clarity on financial planning and diverse asset class. Recommendation number 4. Think and Grow Rich. Written by noted author Napoleon Hill. This 240-page book has inspired generation of readers to develop their skills and become master at anything they do. It offers an in-depth curation of 13 common habits of wealthy and successful people, researching over 500 individuals. Considered as the father of personal development books. Napoleon Hill has received assignment to interview Andrew Carnegie, who has challenged him to interview other successful people for exploring a simple formula for success. The result of that challenge was this book, Think and Grow Rich. The book starts with the concept of power of thought, followed by importance of desire, faith, autosuggestions, specialized knowledge, imagination, organized planning, decision, and persistence. It is then followed by the power of mastermind and subsequently includes mystery of sex transmission, subconscious mind, brain, and the sixth sense. The book concludes with emphasis on how to outwit the six ghosts of fear and the devil's workshop. Here are 3 key insights from this book. Insight 1. Autosuggestion can help you build an unshakable belief system. Developed in the early 20th century as a psychological technique, autosuggestion makes use of placebo effect by turning your goals into self-fueling prophecies through imparting them in your subconsciousness. Author Napoleon Hill says that a key trait of all successful people is this absolutely incredible, unshakable belief that they have about themselves and their goals. It is a necessary prerequisite to become successful. In thinking and reassuring yourself again and again, it is possible for you to achieve your goals, that you can strive towards making your dream a reality. You help form this belief in your subconscious over the time. This helps build not only the confidence, but let your goal get deep into the unconscious part of your brain, so that your action can lead you straight towards your goals. This belief system is fundamental to changing the direction and laser focus on your goals to achieve them with confidence. Insight 2. Always sticking to your decision and being stubborn. Napoleon Hill quotes lack of determination as the most common reason for long-term failure. And millionaires, on the other hand, make snap decisions and stay right by sticking to them. For example, when Henry Ford decides the Model T would be his masterpiece, he knew this. It would be for the long haul. Thus, in spite of people telling him to come up with a new model again and again, he stuck to it. It is often argued that opinions are cheap and everyone around you has one. Most people dispense them like paper towels, thereby cluttering your mind with negative influences. So be cautious who you share your goals with and make it a close circle of trusted advisors, close friends and allies only. Stick to your decisions no matter what and strive towards making them right. Insight 3. Expand your learning by joining mastermind groups. It is said that Napoleon Hill invented the mastermind group as we know it today. Millions of people use it on a daily basis. With the internet, it has become a worldwide phenomenon, as it has become easier to hold a mastermind session with people from around the globe. Hussell defined a mastermind group originally the coordination of knowledge and effort of two or more people who work towards a definite purpose in the spirit of harmony. Benefit of masterminds includes from sharing experience, ideas, skills that could never be achieved if each person worked on their stuff alone. Combined with the brain power of two or more people to solve problems, the result is always more. And hence, masterminds are really powerful. You can find groups on relevant topics all over social media networks like Facebook, LinkedIn, and other online platforms. It should comprise people who are in the same industry and share many problems, obstacles, as well as character traits. However, groups can be of any size, and each session must follow a specific agenda. NE8x recommends Think and Grow Rich to the late teens who are looking for motivation and positive affirmations for developing self-confidence. It is a must-read for entrepreneurs or folks with entrepreneurial mindset for helping in decision-making skills and overall approach towards financial freedom. As we move to our final recommendation, we hope that you jotted down key points that might be helpful to you in the journey towards financial freedom. It is often said that all leaders are readers, but all readers might not necessarily be leaders. It means that we as readers often browse through books in general and never read them with the purpose of creating an impact or taking action based on the key learnings from the book. We urge you to take the leap this time and unlock your hidden potential by taking the right action for achieving financial excellence and beyond. We are hereby sharing a curated list of 10 must-read books exclusively for you that will guide you and help you get better with money and investing in general. The reading list includes: Number 1. Money, Master the Game by Tony Robbins. Number 2. The Barefoot Investor by Scott Peck. Number 3. The One-Page Financial Plan by Charles Richards. Number 4. The Little Book That Beats the Market by Joel Glenbart. Number 5. The Millionaire First Lane by M.J. DeMarco. Number 6. I Will Teach You to Be Rich by Ramit Sethi. Number 7. The Total Money Makeover by Dave Ramsey. Number 8. The Automatic Millionaire by Dave Beck. Number 9. The Millionaire Next Door by Thomas J. Stanley. Number 10. The Almanac of Naval Ravikant by Aaron. Recommendation number 5. The Intelligent Investor. Written by Benjamin Graham, known as the father of value investing. This 640-page book aims at preventing potential investors from substantial errors and also teaches them strategies to achieve long-term investment goals. In the book, The Intelligent Investor Summary, Graham has explained various principles and strategies for investing safely and successfully without taking bigger risks. Benjamin Graham, although coming from poverty, he became an excellent student at Columbia. He later started his investing career on Wall Street and wrote down his investing principles in 1949 inside the book. Renowned investor Warren Buffett calls it the best book on investing ever written, and written a foreword for the same. Chapter 8 and 20 are among his favorites, that covers the investor and the market functions, followed by margin of safety as the central concept of investment. Here are 3 key insights from this book. Insight 1. Don't trust the market always. Meaning, Graham pictures the entire stock market as a single person. And his most famous analogy is about Mr. Market showing up on his doorstep every day, quoting you different price for various stocks. What would you do? It is often argued that you would be better off ignoring him altogether. Sometimes the price he will tell would seem suspiciously cheap, sometimes astronomically high. That's because markets are totally unpredictable most of the time. If you aspire to be an intelligent investor, it is advisable to rely on your own research and ignore the market altogether as much as possible. As humans, we are as good at recognizing patterns that at times we even try to find patterns even when none exist. That's why when a stock price goes up for 10 days, we mostly argue that it must go up further, which is of course not true most of the times. Such analysis without your own research can lead to blunders. So avoid trusting the market and do your own research instead by digging deep with facts, positions, chart and analysis over a period of time. Insight 2. Understanding 3 principles to become an intelligent investor. According to Benjamin Graham, value investing rests on 3 principles. Number 1. Intelligent investors always analyze long-term evaluation and management principles of a company before investing. Number 2. They always protect themselves from losses by diversifying their investments. Number 3. Intelligent investors never look for crazy profits, but instead focus on safe and steady return in long term. With thorough analysis, intelligent investors can find stocks with a gap between their current price and the intrinsic value of the company holds, and will eventually unlock. This is based on the evidence collected from fundamental analysis and looking at the company's history, along with their long-term plan and the organization's management values. A famous quote by Warren Buffett is about his 2 rules for investing. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Nobody today can predict the next tech giant of tomorrow. So as an intelligent investor, it is smart to invest in a few of those emerging companies so that They don't lose everything when things go wrong and then sit back, collecting decent returns yearly. Insight 3. Stick to your making investments. Graham calls it formula investing, and it's more widely known as dollar cost averaging. This concept means that every month or quarter you simply set a fixed budget you are going to invest, and then invest that into the stocks you have previously picked, no matter the price. Practices like this saves you from emotional stress of investing with the market, although investing the same amount again and again on the same stock can get you emotionally damaging. But once you get over it, it's a great way to protect yourself against losses, which could happen if you invest a big sum right before a crash. So always stick to your investment no matter what. NE8x recommends the intelligent investors to beginners in stock trading for practicing some of the basic fundamentals in the investing strategy. It is also most recommended read for professional traders who have been trading for quite some time and might have lost and are open to learning more long-term strategy to diversify stock trading. For folks who like Warren Buffett and follow his wisdom when it comes to experimenting with great companies for a long time, they will love the Intelligent Investor book and will definitely bookmark select pages for references. Hope you like this brief covering insights on financial perspectives with guided knowledge from these 5 well-known self-help books handpicked by us. Do grab your copy of these 5 books from the link in the description attached. We have covered key insights, but a thorough read through them is definitely going to be worth your time. Comment below to let us know which one of this book is going to be on your next reading list. Subscribe to NE8x for such insightful videos and explore our other videos. Create, innovate and inspire.